Y'all aren't gonna believe this. You know all that work I did last week on these pro forma statements on our Zoom meeting? Y'all remember that, right?
Yeah.
You know where I saved it? It's on my desktop on my computer at the house. Yeah, that's just kind of the way things work. I thought I'd saved it to my Dropbox, but I can't find it. So at any rate, that's where we are. It won't take me long to replicate it. And I said I was going to redo it anyway, didn't I? All right, I've got Mac and Brian and Aaliyah and Seth and Zach and Maria's back and the three troublemakers on the back right row. Hey, y'all. And there's Lynn coming in and Jake was in earlier. All right. And there's Ashley. Okay, awesome. Awesome. So I want to redo what I did last week and save it where I can find it next week when we do this again, okay? So essentially, all we're doing is setup. Here's the deal. I'm going to keep y'all on track and hold you accountable. My goal before I leave here in an hour and 20 minutes is to have the assumptions and the sources and uses of funds done. To hold y'all accountable and keep you on track, I want you to have your assumptions and sources and uses of funds done by Sunday night at midnight. And I'm going to create a Dropbox for you to upload those to me, okay? If you'll upload those to me, I'll give you 10 points for each. That's not bonus points. It's coming out of the points that you earned for doing that, okay? I'll give you 10 points for each of those, but the bonus is, Tyler, I'll give you some feedback. If you're going down a bunny trail, if you're on the wrong track altogether, I'll give you feedback about that, okay? If you're fine, I'll give you the 10 points. But what that does is it keeps you motivated to stay on track, okay? And part of this, honestly, I'm trying to keep you out of trouble because I know this for a fact. If you wait until the last minute and find yourself desperate because you're behind at the last minute, it's real easy to cheat. And I'm real good at catching you, okay? Because I've seen so many of these, I know what they look like, okay? So by holding you accountable, right? By holding you accountable, my goal is to reduce the possibility of you having to cheat. I don't want you to be desperate, okay? So I'm going to go to loop.net or loopnet.com. Remember, I've already picked what business I'm in. It's the furniture business. And I'm looking for a location. And I had picked a location for lease in Wichita Falls. And it's the old Home Zone location. So all I'm doing here is just scrolling in, zooming in. Okay. And I'm trying to find it. Let's see, let me get oriented. Old Iowa Park Road. Okay. We're not in the right place yet. Here we are. There we go. That is my location. 3127 Lawrence Road. It's 20,536 square feet of retail space. It was a furniture store. I like that. It's negotiable. Y'all help me out. I worked with you on the logic of how much I was going to offer per square foot. How much was that?
It was something that added up to like $1.
$1 a square foot per month, $12 per year?
Yeah.
Okay. All right. So going back to my Excel. Okay. My very first assumption is what the business will be. Business is a retail furniture store. Okay. The business will be located at 3127 Lawrence Road. Okay. I'm going to go on the assumption that I can get it for $12 per square foot per year triple net. Although they indicate here that it's the type of lease is negotiable. Okay. And they give you the definition. There's gross lease, modified gross lease, industrial gross lease, triple net. Okay. Please understand this, y'all. Please understand this for me. Okay. If I'm talking about anything on a lease that costs my landlord money, they're just going to add it to the lease. Okay. And that might be acceptable for you. But usually, here's the deal why I might not necessarily want to do that. Smart investors realize that their money needs to have a return. Were y'all in the Foundations of Business class, and I come in and guest lecture, and I talk about there's two types of people. There's people who earn interest, and there's people who pay interest. Seth remembers that, okay? If you push the cost, the traditional cost of a lease down to your landlord, it's going to take money out of their pocket. If they take money out of their pocket, what does a smart investor demand when they take money out of their pocket? A return on their money, right? So if we push costs down to them, we're not only increasing our cost by whatever cost we pass over to them, but because they're a smart money person, they're going to demand a return on their money. We not only push our costs down to them, but we push the cost of their money back on us. So it winds up costing us more. Okay? So I'm going to say it's a triple net lease. This gives you the options. Okay? Triple net is what we're talking about. The tenant is responsible for all expenses associated with their proportional share of occupancy of the building. That includes repairs and maintenance. That includes taxes, and that includes insurance. Those are the three things typically for a triple net lease, okay? Going back to my PowerPoint. Location is 20,536 square feet, I think. Yep, 20,536 square feet. Proposed lease is 5 years, okay? At $12 per square foot per year, okay? And I'm just using some abbreviation because I'm in a hurry. I don't want to spend a lot of time trying to catch up, okay? See what I did there? The term of the proposed lease is $5 per foot squared, per square foot per year. Okay? I know that I did this, but I better do it again. Yes, ma'am, Kira.
Remember, I said I wanted to do mine as an online retail.
Uh-huh.
But I was wondering if I decide to use, I guess, my apartment as my storage unit.
Right. Okay, so here's what I'm going to tell you. Her question is, she's going to do online retail. Can I use my apartment as my storage? The general answer to that question is no. Okay, and here's why. Your landlord's probably got a stipulation in your lease that says you can't use that apartment for commercial purposes. Okay, it's probably written into that lease, and most leases it is. Okay, you can't conduct business in a residential space, because what you're doing, if you do that, is you're increasing the risk to your landlord, but you also run the risk of creating a nuisance to your neighbors. Like if you got UPS running in and out of there 13 times a day, bringing you product and picking up product, right? You may not be zoned appropriately. And if it's an apartment, I can guarantee you it's not zoned appropriately. So here's what I am going to require everybody to do, and I'm jumping a little bit ahead when I say this. Everybody in this class, even if you choose a home-based business, everybody has to take out a loan, and everybody has to purchase at least one fixed asset. There's a couple of very specific reasons that I'm doing that, Kira. It's not to be a jerk or anything. I want you to know how to treat fixed assets on your balance sheet and on your income statement and on your cash flow. And I want you to know how to treat a loan amortization. Okay? Okay? So I'm looking for property tax. I'm going to wichitatax.com. I'm going to look it up by property location, 3127 Lawrence. And you remember, if you recall, I said don't be too specific when you're looking this information up. I put in Lawrence Road there, and it said no properties returned. So if I just do 3127 Lawrence, oh, it thinks that I'm spamming it. All images with boats. There's a boat, there's a boat, there's a boat. Is there a boat in that? I don't see a boat in that one. I've seen boats in the trees before. When I was in Mississippi doing that disaster relief. Okay, and you remember we have to figure out which of these specifically is our physical location. Okay, because you see we've got a lot of business personal property listed here. United Leasing, Puget Sound Leasing, Megan Gary, United Leasing, Furniture Factory Outlet, Falls Power Tan, business personal property, yada, yada, yada. Okay. Powerhouse Gym. Gary Meehan, DBA GM Properties. Okay. This is the legal for the real estate. Property taxes on that location run $28,857.13 per year. Okay? Why do I need that? It's a triple net lease. Okay? Again, I'm just trying to make this really quick and easy for you. I can go back later and fill this in. The term of the proposed lease is 5 years at $12 per square foot per year in. That's triple net, okay? I'm gonna put those property taxes in at $29,000 per year, payable in December. Okay, so that's when we have to pay our property taxes in Wichita County. I've called my good friend, the insurance agent over at Pond Insurance, and he's given me an estimate. Okay. Y'all, for commercial insurance, you typically, it's like when you have a homeowner's policy, it's not like calling the general, go to the general and save some time. You're not making monthly payments on that, okay? Or a great low rate you can get online, okay? I'm glad somebody watches TV and has seen that annoying commercial. Okay, it's payable in advance, okay? Repairs and maintenance. Maintenance. How do I spell maintenance, y'all? Okay, I was brain burping it. Okay, because that location is in good shape and I'm gonna make sure it's in good shape, I'm gonna budget a very reasonable $500 a month. That's just a budget item, y'all. And I'll be the first to admit that's a wild guess. What they refer to in the industry as a WAG. I'll let y'all decide what the A stands for. Okay, it's just a wild guess for me. As long as it's reasonable, I don't have a bit of problem in the world with you making a wild guess. As long as it's reasonable. That's one of the reasons that I want you turning in preliminary work each week is if I see that you're making unreasonable assumptions, I'm gonna point those out, okay?
Would that be included in like the Ibis reports with repairs?
It probably is not broken down to that level of granularity. Yeah. I've got the Ibis World reports pulled up, but you know, there's so much, they can give you an industry average, but there's so much that's specific to a location. I mean, if you've got a brand new building with brand new systems, there's probably absolutely nothing that needs to be repaired within the first 5 years. Whereas if you've got one of those downtown clunkers that was built in 1919, you'd have to spend $5,000 a month on repairs and maintenance, right? So it's, all right, so I've got my triple net stuff, taxes, insurance, and repairs and maintenance, okay? Let's go to our Ibis World report, okay? This is my Ibis World report, y'all. Why? That's weird. Stop sharing and see if I can fix that. I don't know what's happening here. Let's open it again. Got to log into my email again. Wrong. I love it. Okay. Go to not banner, not TouchNet.
Have y'all successfully received your Ibis World reports? Scott, did you get yours? Okay, good. Everybody else? Ashley, you hadn't asked? Okay, when did you ask? Okay, they'll probably get it for you. If they don't get it for you by Friday, let me know, okay? Sky, you sent me an email. Is that just a LinkedIn request?
Oh, yeah.
Okay, all right. Cool. Just make sure I didn't miss something. Okay, so here is our Ibis World report. Okay, industry at a glance. Okay. At a glance, that industry does about $59 billion a year in sales. Okay. 58.9 billion in sales. Okay. Annual growth is pretty flat. Profit margin about 4%. 27,539 businesses. Okay. Here's what I'm going to do. I'm going to open up my calculator. Okay. 57.9 billion divided by, that's 57,900,000,000 divided by 27,539 businesses. Okay, that means an average business does $2.1 million per year. Okay. That's just giving me a sanity check, right? Y'all remember? Okay. What's reasonable? I gave you another rule of thumb just as a sanity check, okay? I said your occupancy cost should be no more than about 10% of your total revenue, okay? Mine's going to run a little bit higher than that, but I'm in a really high visibility location there on Lawrence Road. And because I'm in a high visibility location in something that was already a furniture store, what I'll do to offset that is I'll put my marketing expenditure a little lower than the industry average. Make sense? I mean, how many cars do you think drive by that a day? Probably 30,000, I'd be willing to bet. Okay. All right. So I think we said that we expected my business expects to sell 1.8 million in the first year. That was 150,000 monthly. And that's an average. This is going to be a seasonal business, y'all. Okay, it's going to be a business that's not the same every month. Okay. Back to my Ibis World report. Okay. I want to get to those financial statistics. When I get there, y'all, I will make it bigger, I promise. Okay, this gives me my cost structure benchmarks. Okay. Remember I told you about this purchases deal? I said purchases is roughly the same as cost of goods sold. Okay. Cost structure benchmarks. Profit is about 4%. Wages about 13.8%. Purchases 60.8%. That we're going to call that my cost of goods sold. Okay. So coming back here to my Excel sheet. COGS, I'm just going to abbreviate. And I'm just telling, where did that come from? You know, it comes from the industry average. Okay? Because it'd be a kind of a weird thing to just pluck 60.8% out of thin air. And y'all remember what I told you about furniture, right? It's a mark them up and mark them down sale. Right? List price on furniture is typically 2.5 to 3 times what it costs the retailer. So when they have a half off sale every year, they're still making money. They're just not making as much as they normally would. Okay? So my industry average is 60.8%. Okay? I need to do a calculation here, and I know that this is in the video, so I won't bug you with putting it in again. I'm going to share my calculator with the folks on Zoom. I'm going to sell 1.8 million. Okay? My cost of goods sold is 0.608. Okay? That's 1,094,400. Okay? Going back to my Ibis World report. I think that my inventory, average inventory was 104 days. Does that ring a bell? 104 days? Okay, revenue, key ratios. All right, days inventory, 104. Boy, I'm glad I've got a good memory, okay? All right. So back to my spreadsheet. Okay, 104 days. There's an easy way for me to get here. It's not going to be the same as I showed you in the video. If this is 1,094,400 and there's 365 days in a year, if I divide that by 365, my daily cost of goods sold is about $3,000. If I multiply that times 104, I need to have $311,829 in beginning inventory. That's 104 days. Sure, I can. Okay. So my total sales are 1,800,000. Okay. My cost of goods sold for the entire year is 0.608 or 60.8%. Okay. That means my cost of goods sold, am I sharing this? No. My cost of goods sold for the entire year is $1,094,400. Okay? All I'm doing is multiplying my sales times my cost of goods sold percentage to see how much my total cost of goods sold is for the year. How many days are in a year? 365, right? So I divide that by 365. If I'm open 7 days a week, which we kind of assume when we say 365, right? And most furniture stores are open 7 days a week. Most of them are. Then my daily cost of goods sold is $3,000. Okay? And if I'm open 104 days per year, if I multiply that number times 104, then that gives me how much inventory I should have in stock, which is 300. I'm going to just put it in at 312,000. How about that? Okay.
Do you want to hold just an assumption of?
I'm going on what the industry standard told me. Again, I didn't pull that out of thin air. I looked at my Ibis World report. This is why I want you pulling that report, y'all. This is why you get that information. Otherwise, it kind of looks like, the hell's he talking about? 104 days worth of inventory. Remember, here's the deal, Garrett. Here's the deal. Your banker has these industry standards. Not only that, but your banker has a world of experience. They've seen businesses come and go. They know what the industry standards are for a furniture store because they're already banking Hamilton Bryan and Home Zone and Ashley and Johnson Furniture and Mattress. Okay? And oh yeah, they were also banking FFO before they went out of business, right? So they know. All we're saying is I'm doing this in accordance with industry standard, okay? And if you'll recall, what I wanted to explain, I don't know if I did a real good job of it, y'all, it's hard teaching you on Zoom, okay? What I wanted to explain to you is my biggest startup cost is inventory. It's buying stuff that I can sell, right? If you ain't got it in the store, you can't sell it, okay? So I need to know how much beginning inventory I should buy. I put 104 days worth of inventory in stock, and that means that my beginning inventory is 312,000. And here's going to be the way it works for me, okay? Remember, I'm using the accrual basis of accounting, which means every time I sell something, it becomes cost of goods sold. Okay, so essentially the way that it's going to work is whatever my beginning inventory is what it's going to remain. But every time I sell something, I replace it with something of equal value. Does that make sense? So what's my beginning inventory on my balance sheet for opening day? It's 312,000, right? What's my ending inventory at the end of the year? Because I'm replacing something every time I sell it. What's my ending inventory? This isn't a trick question. Yeah, thank you, Brian. My beginning inventory and my ending inventory are exactly the same amount. It never fluctuates. Every time that I sell something, I replace it with something of equal value. Make sense? That's a whole lot better, okay, than having a fluctuation in your inventory each month that you have to keep track of on your cash flow. Okay? We just treat every time you make a sale, if you make a $5,000 sale, your cost of goods sold is roughly $3,060 on a $5,000. This is 60.8%. And we show that cost of goods sold, right? But we're replacing it by buying more to replace it. Okay? I'm foreshadowing the cash flow, but the way that the cash flow will work is you'll have a line that says beginning inventory, 312,000. You put that in the column that says pre-startup, and you never buy your beginning inventory again. So for January, February, March, April, May, all through the year, your beginning inventory is zeros. Okay? Then you have another line that says cost of goods sold. And cost of goods sold is always equal to 60.8% of whatever your sales are that month. Okay? Because we're replacing it every time we sell it. Okay? All right. let's talk about this location a little bit more, okay? It was previously a furniture store, so no renovations are needed. Make sense? I picked that location because it was a furniture store, right? I could do renovations on a location if I wanted to, and if I thought that location smelled of death, I wouldn't pick that location. I think what happened to FFO is a pandemic came along. And quite frankly, I think that Wichita Falls is a little crowded on furniture, right? With Conn's opening up just down the street. I haven't been in there, but what a horrible name for a business that sells primarily on credit. What a horrible name. Is that ironic to anybody else? I mean, that's what they're known for, right? It's kind of like the old Heilig-Myers Furniture model that I told you all about. I worked for Heilig-Myers Furniture. They sold lesser quality products at a very high interest rate installment plan. Okay. All right. All right. So I've got my sales. I've got my location. Let's talk about employees. We're going to hire 6 people. In addition to me, okay? I'll have 3 commissioned salespeople. And I'm going to make those guys purely commission, okay? Whatever the gross profit is on the product, they make 20% of it. That's pretty standard, okay? When you get your degree, okay? That's only $4,000 a month. It's a salary, so plus you got to manage. So I might expect you to be there 7 days a week, Mary. Okay. Office manager making $48,000. 2 delivery people. $12 per hour. Let me change that from annually to annual salary, just so I'm clear, okay? That's going to be $4,000 per month, okay? Workers' compensation insurance will cost 3.5% of annual payroll in advance. Okay? Payroll taxes will equal 11.15% of payroll expenses. Okay, payroll taxes paid immediately when they're incurred. Did anybody ever handle payroll? You handle payroll now?
No, I
Not
haven't.
now, but you have. So the way payroll taxes work is this. For your federal 941, your payroll taxes, the money that you withhold from your employee's paycheck and the money that the company matches, depending on how much money you're talking about on a weekly, monthly, quarterly, annual basis, more than likely, if you have a decent sized payroll, you have 3 days from the time that you make payroll to deposit the payroll taxes at the bank. Okay? Literally, if you pay on Friday, you have until the following Tuesday to deposit the payroll taxes. That consistent with what you had to do? Okay. Now, if you have a low payroll, you know, if you only have one employee, they might let you pay quarterly. But the IRS really doesn't like for you to get into tax trouble. And we're going to have a pretty substantial payroll here, y'all. Okay, pretty substantial payroll. I mean, $4,000 a month, 11.15%, we're bumping up pretty hard and fast against $500 a month just on that employee, plus money that's not mine, okay? That employee's federal income taxes that I withhold from their check, I'm a trust agent for that, and I have to deposit that as well within 3 days. So it's very likely that that person might have $1,000 a month in federal income tax withheld from their check. Okay, if they're single with no dependents, they could have extra money withheld, right? Because they know they're going to have a big tax burden. You got 2 delivery drivers, you got commissioned salespeople. I mean, you could literally be depositing thousands of dollars each week in payroll taxes. And the reason the IRS wants you doing it within 3 days of payroll is you go a couple of weeks and don't do it, you get in trouble. And those dollars, they're pretty much non-negotiable. The moment that an employer starts donkeying around with your money is the moment that you should be looking for another job, okay? If an employer is saying, well, I know you were supposed to be paid on Friday, but I can't pay you until Tuesday of next week, or I'll give you a check today, but can you not deposit it? They're giving you some very real clues, right? You better be looking for a job, okay? The IRS doesn't donkey around with payroll taxes. It's paid immediately, okay? And if you use a program like QuickBooks, it actually is built into QuickBooks that they'll come in and draft your account when it's due, okay? Okay, the business, I didn't put this assumption in, but I should. Business is a retail furniture store. Oops. Operating as a sole proprietorship. Okay. What does that mean? We just had lecture over chapter 7 on Monday. Okay. There's one owner, right? I can put money in, take money out really easily. I don't have an ability to pay myself a salary as a sole proprietorship. my money is called a draw. And it's not a taxable event for me to take money out, okay? But I do need to plan for that, okay? The business will purchase a delivery van for $35,000. Okay, I'm buying used. Depreciated over 7 years straight line. Do we need to talk about depreciation expense just a wee bit? Sky, if Sky's saying yes, I'm betting that other people want to hear it. Okay. All right. Your sister Chanel, she want to hear it too.
Yeah.
Okay. Depreciation expense is cost recovery of our fixed assets. Okay? When we buy something like a delivery van, y'all understand that it's going to last longer than the current accounting period. Right? If we bought a delivery van and it only lasted for a year, y'all understand that would be a problem. Right? So the IRS has a set of rules that says what the expected life of stuff is. If you buy, for instance, residential real estate, it's 27.5 years. That's what the IRS says is the life of that building before your tenants tear it all to pieces. Okay, it's 27.5 years. So you would depreciate that each year for 27.5 years, which means you take a portion of the cost of it each year for 27.5 years. At the end of the 27.5 years, the book value of that asset is 0. Okay? In other words, it's worth nothing. And is it very likely that if you've had a tenant for 27.5 years that you probably need to rebuild? Okay. The IRS says, for example, that if you have a building that you buy for commercial purposes, that building is expected to last 39 years. Okay? In other words, it's owner occupied. Okay, it's your building. You're going to take a little better care of it, but expect to get about 40 years out of it. They say you'll depreciate it over 39 years. If it's a computer, probably 3 years. Now, there's some flexibility. There's some latitude in what a depreciable life of an asset is. And I'm not giving you an IRS tax class. Okay, this is not a tax class. Whatever you think it's reasonably expected to survive, just take that, right? But I do require you to buy a fixed asset because we're going to treat it for depreciation, okay? And more about that as we go, okay? So the deal with this straight line depreciation is that's the most simple modality for you to calculate depreciation expense. There's all kind of different rules. There's makers, there's acres, there's double declining balance. If you want to learn about all that stuff, knock yourself out. Dr. Anders will be more than happy to educate you about tax accounting, okay? I'm simply using straight line because it does not require us to go to any depreciation table. We don't have to do any calculation other than 35,000 divided by 7 is 5,000 bucks a year. 15,000 divided by 5 is 3,000 bucks per year. Okay? You with me? Okay. Are you feeling a little better about the assignment? No? Jesus, Mary, and Joseph.
Yeah, no, I'm good.
Okay.
It's starting to make sense. It's just a lot all at once.
Yeah, it is a lot. It's drinking from a fire hose, Drew. You're absolutely right. It's kind of like that COVID test. It's a lot of fun. Okay? All right. So I think I have enough. Go ahead. I'm sorry, Kira. Go ahead.
The fixed asset, what if instead of purchasing the bond, sorry, what if you already had a vehicle and you decide to use that?
If you did what? Pull your mask down.
I'm sorry, what if you already had a vehicle?
Okay.
And you decided to use that as your fixed asset?
Okay. If you have one and you decide to use it, that's fine. Okay. You can count that as part of your equity investment into the company. Okay. But it needs to show up on your financial statements. So for instance, if let's say you were doing, let's say that you were doing a food truck. Okay. That's a pretty common business that people like to do. Okay. But part of having a food truck is, food trucks really aren't food trucks. Most of the time, food trucks are food trailers, right? But you got to have a truck to tow the trailer with. Okay. So people want to count their vehicle, their personal vehicle, as an investment into the business. That's fine, as so long as you count it as you're injecting it. The business will now own it. That meets the requirement that I said you have to have a fixed asset, right? Now, the value of it and how you depreciate it and all that stuff, that's why you hire an accountant. It's just easier, honestly, for the purpose of this exercise is if you treat it as if I'm buying it. Yeah. And really, if your business is anything other than a sole proprietorship, that's really what you should do anyway. The business really should write you a check for the vehicle. You should transfer the title to the vehicle over to the company, right? And if you want to turn around and put that cash right back into the business, that's fine. It'll be paid in capital, that's fine, right? Okay. But it does truly need to belong to, Jose?
Rows 19 and 20.
Uh-huh.
Where are the percentages from?
I talked to my insurance agent when I was talking to him about that $10,000 annual policy. I'm pulling them out of thin air, but they're based on years of experience. They're based on years of experience. I can tell you specifically about the payroll taxes, but workers' comp, let's address that because that is a question that you'll have, okay? I kind of touched on it in the Zoom call last week. Workers' comp is based on risk, okay? Your workers performing menial or manual labor on your behalf puts them at risk, okay? So if you have even one employee doing labor, even if it's filing stuff, right? They need to have protection because if that worker was injured on the job, it's your responsibility to pay their medical bills plus their lost wages until they go back to work. Remember, I gave you the example of my cousin who worked for Marriott International, right? He was out of work for 1.5 years because he fell off a roof and broke his foot. After he broke his foot, because he was walking in a boot like this for 1.5 years, it tore up his other knee.
So before he could go back to work, he had to have knee surgery on the other knee because of the pressure that it puts on you. Never missed a paycheck. Now, Marriott International is self-insured, and his insurance benefit, his workers' comp insurance benefit, was $675 a week. But that's less than the 33 bucks or so an hour that he makes, right? So there's a minimum amount that you have to pay for workers' comp benefit. And if you don't have insurance, it's on you. So workers' comp is based on two things. It's based on what industry you're in, okay? That's called your rate modifier. And it's based on your experience factor. Your rate modifier is the level of risk. The experience factor is what's your claims history like, okay? Now for a rate modifier on me, for a new business, the rate modifier is 1, right? We can't say that that business is any more risky than anyone else that's in the furniture business, or any less risky than anyone else in the furniture business. There's no reason for them to charge me a premium on my premium or to discount my premium because I have no track record. So my rate modifier is 1. The 3.5% is based upon what's the risk within that industry. Since we've got people in the showroom, in the warehouse, even the office manager, Mary, you ready for this? You may have to help lift a couch or a dining room table one day, okay? Pretty much everybody's gonna be at the same level of risk. There's gonna be a line in everybody's job description that says any other duties as required by a supervisor, okay? And if I need Mary to go help load a desk because Sky's out, Sky's one of my delivery people, and she's out, and Mary has to help load that desk and go on a delivery, then small business with 6 people, we're going to do what we have to do to make it work, right? So the rate modifier is based on the level of risk. The experience factor is based on the number of claims that you've had historically. I can assure you that if you have a lot of claims, your experience factor is going to go up. If the insurance company perceives that your business is twice as risky as other people in the furniture business because of your claims history, your premium is going to be twice as much as other people in the furniture industry because you have twice the level of risk. If you don't have any claims, your premium will go down because your experience factor will be less than 1, okay? So those are the two things that determine. An example of a place that, or an industry that has a god-awful and exorbitant rate modifier, roofing. I don't know what it is in Texas. In Georgia, it's 40%. For every $1,000 that you pay in payroll to a roofer, you have to pay $400 in workers' comp premiums. Okay? Why? Because if somebody falls off of a roof, it's not going to end well. Okay? You see what I'm saying? There's workarounds in that. Most roofing contractors don't have employees. They've got independent contractors. And the deal with an independent contractor, this is a lot more information than you wanted to have. The deal with an independent contractor is you can't control that employee's behavior. You can't control their work schedule. You can't control whether they work for other people. You can't provide them the tools. You can't dictate how they do their job. You don't supervise them. You pay them for doing the job. Okay? The moment that you start trying to control their behavior and tell them that they have to be there at 7 a.m. and they work until 1:30 because it's a roofing company and it's hotter than the hinges of Hades after lunch, right? The moment that you set their schedule,
You've just made them an employee. Okay, so the standard practice in Georgia is they're independent contractors. We'll pay you per bundle of shingles that you install. That's the deal. That's how they're paid. Because can you imagine having a 40% workers' comp premium? And imagine just having a couple of people fall off a roof, land on their head, right? And get your rate, your experience factor doubles, and now you're paying $800. It's crazy, okay? I think I got enough information now, all right, to get started on my sources and uses of funds. I've kind of put the numbers together in my mind. I'm gonna have $312,000 in beginning inventory, $10,000 paid out in property taxes payable in advance. Okay, so that's $322,000. I'm going to purchase a delivery van for $35,000. Now I'm up to $357,000. I'm going to have $15,000 in furniture, fixtures, and equipment. Okay, so now I'm at $372,000. I'm just going to do another wild guess. Okay. I'm going to borrow $375,000 to start. Okay. Y'all, I hate these stupid covers that they've put over these things. I can't see the keys, and if I can't see the keys, I can't type. Okay. I'm borrowing that money for 5 years at 6% interest. Okay. Now, let's talk about that for a minute. Okay. The most of my money is going for inventory. This isn't a trick question, but how long does my inventory hang around? I heard exactly the number I wanted to hear over here. 104 days, okay? So do I want to borrow that money for a really long time? I don't want, this is just common sense, common financial sense, y'all, right? It's the same reason you wouldn't want to put your lunch on a credit card that you're not paying in full every month. I mean, if you're paying in full every month, that's good. But if you're carrying a balance on your credit card, you realize that if you pay the minimum payment, you're still going to be making payments in 59 months on something that made a turd tomorrow. I know that's rude. But do you understand what I'm saying? And you'll remember that example, okay? You wouldn't buy a house on a credit card because a credit card is considered a current liability, okay? Good financial practices dictate that you actually should pay that credit card in full every month, okay? That's just being a smart person, because if you're not, you're probably paying 18% minimum APR, okay? So if you can pay it every month, that's fine. Use your credit card. It's the reason that Dave Ramsey says don't use credit cards, because most people with credit cards don't pay them off every month. When I was your age, I didn't pay them off every month, okay? But now, by the grace of God, I can. And I maximize the rewards points. And I have a reward program with almost every credit card I have. And whoever's giving me the best deal, that's the credit card that gets moved.
that gets used every month. The reason I refinanced my house, I had looked at refinancing my house half a dozen times, and I couldn't make it make sense because of the closing costs. But when American Express sent me an offer that said, we'll give you $2,500 statement credit if you refinance your house with Quicken Mortgage, that tipped the scale. And it made financial sense for me to refinance my house because there was about a $2,500 deal in there that it just didn't make sense. Because when you refinance your house, you got to add your closing costs back into your cost, and it cost me over $10,000 to get that loan. Okay? But because my interest rate went from 4.125 to 2.65, and because I got a $2,500 statement credit from American Express, and I was able to buy stuff that my wife didn't know about, I kid a little bit. I told her about it later. Okay? So, you know, if I was just buying money, if I was only buying money for working capital purposes, I'd want to have that money on a current liability, quite frankly, which means I'd want to have a one-year loan. But because I'm buying some fixed assets, I'll use it a little longer, right? I may go back and adjust that and say 3 years. I don't know what my cash flow is going to look like right now. I'm just kind of throwing out some stuff that I think makes sense. Okay? All right, y'all. So I'm going to rename this tab Assumptions. Okay? I may not be done with my assumptions. I can assure you I'm not. Okay, but I want to name it. I'm going to create a new tab, and I'm going to call that Sources and Uses of Funds. Okay? Nothing fancy about this. Do y'all remember what I told you has to happen with your sources and uses of funds?
Has to be documented.
Anything over $500, you need to have a cost estimate because your bank is actually going to write a check payable to whoever that is, right? Because they don't trust you that much. Okay? But here's the deal with sources and uses. They've got to be equal. The source is very simple. Where is it coming from, right? You read the bottle, Nestle Pure Life, bottled at the source, Blue Springs, Florida. Right? Tells you where it came from. What are the uses? That's where it's going. Okay? What am I going to do with it? Okay? So up top, I've got sources of funds. Underneath that, I've got uses of funds. Okay, my sources. Remember, I just said I'm going to borrow $375,000. Okay. I'm going to come in with 25% equity in my project. $125,000. Okay. So what's my total sources? It's 375 plus 125. Okay. It's $500,000. What's my uses of funds? Beginning inventory. You remember I said I needed $312,000 in beginning inventory? I said I needed a vehicle that was going to cost me $35,000. Okay. And I was going to need furniture, fixtures, and equipment. That's the general abbreviation that you'll see for furniture, fixtures, and equipment. It's FF&E. Okay. That was $15,000. All right, I'm not done yet. My uses and my sources have to match. So here's where I make it match. My total uses, since they have to match, I'm going to put a formula in this cell right here, D11, that says, go up there to cell D4 and bring that number down here. In other words, make cell D11, make my uses equal to my sources. You see what I'm doing there? The reason I want to put a formula in there that says go get D4 and bring it down is what happened if I decide, oh, well, my market's down. I don't know what the markets did today. I guess they're probably in the crapper, and they will be until after the election. So I decide, hey, I'm really going to be okay putting just $100,000 in it. Do you see how every time that I changed a number, it changed my total sources and it changed my total uses? Okay. The difference between your sources and uses of funds is what we will loosely call working capital. Okay. Now, working capital, the correct definition of working capital is current assets minus current liabilities. Okay? This is not the correct definition. Okay? This is simply uses that we haven't identified. It's not hard uses. Okay? This is really just a plug number. Okay? By the way, I realized something else I just left out. My property insurance. I said it was $10,000 and had to be paid in advance. And Drew asked me the question, don't they need to be documented? And the answer to that is yes. Okay, so property insurance, $10,000. Now, you don't have to put every stinking expenditure, and please don't. Okay, but if there's some big expenditures that you're going to run for the startup of your business, you want to put them in here. To get the correct number in there for working capital, you do this. You put in a formula that says take your total uses and subtract all of the identified uses. Okay? So the formula is very simply take my total usage and subtract inventory, delivery vehicle, furniture, fixtures, and insurance, and furniture, fixtures, and equipment, and property insurance. Okay? And when I hit enter, there's a number that comes in there, and that number is 128,000. Okay? If I find out that I whiffed the property insurance, Jason Pond calls me up and says, Scott, I screwed up. That really is going to be $25,000 a year. I probably say I'm looking for a different insurance agent, right? But I can change that 25,000 and look what happened to my working capital, right? Because I've got a formula in there, okay? So this is very simply a framework, okay? This is very simply a framework. In my assumptions, I expect to sell 1.8 million in the first year, 150,000 monthly average. Okay. I can go a little further with that and break it down even further. Okay. You know, furniture is a big ticket item, right? You sell a living room set, you sell a dining room set, you sell a bedroom set, okay? Maybe you sell a whole house of furniture every once in a while, but an average transaction, an average ticket in a furniture store is going to be relatively high. I'm just getting it to something that I can explain. It's like eating an elephant, right? You break it down into bite-sized chunks. It's just like I told you about the business plan, okay? Can you understand what I'm saying here? I do 50 transactions a month at $3,000 each. 50 times 3,000 is 150,000. 150,000 times 12 is 1.8 million. Make sense? Okay. Do you see my logic here? Okay. So what I have here, y'all, is just a framework. Okay. We sort of got our business model built, right? Because you know how I will receive revenue and incur expenses. Okay. Right? All right. I'm going to save this. Okay. Here's the deal. I will go into D2L tomorrow. I will create a Dropbox folder. That Dropbox folder will be worth 20 points. Okay? You'll get 10 points for uploading an Excel spreadsheet that has your assumptions. You'll get 20 points if that Excel spreadsheet also includes your sources and uses of funds. And it's done correctly. Okay? Now, those 20 points come out of the points that you'll eventually earn for doing the assignment. But that's just my effort to keep y'all honest, to keep you on track. Okay? Trust me, you like me a whole lot better at the end of the semester for a couple of reasons. Okay? You haven't gotten overwhelmed with the assignment, so there's no temptation to cheat. And in addition, you get the assignment done in a timely manner, so it's a lot less pressure on you. Trust me, I will go through this whole stinking assignment with you in this class every Wednesday until we're done, okay? So there's not a lot of pressure on you outside of class to try to do this and try to make it all up at the last minute, okay? You'll do better on those grades. In addition, I'll be able to turn my grading around to you much more quickly, because I will have seen your stuff and I won't have a lot of stupid errors with it. Okay? Makes sense? Questions? Lynn? Questions? You good?
Yeah, I'm good.
Jake, you good? Jose?
When are they, when is it due to submit it to the Dropbox?
I'll put it a deadline of Sunday at midnight. That's a great question. Jose had the same question. I'll put a deadline of Sunday. It'll be midnight, but it'll actually be 11:59 p.m.
Okay.
All right?
Yeah. Thank you.
Thank you. Y'all take care. Stay safe.
You too.
I accidentally deleted the entire workbook.
Oh, no.
Oh, I need to redo it anyway.
Just take the most recent. Yeah. Just pick one right in the middle and just tell me what it is. Days inventory, 117, 104, and 98. I would say 100. Yeah. Yeah, 100.
Okay, so you have to have a big asset, right? So if I like drive my battery
Like, I'm like, obviously, try to work with the
being insurance.
When you were doing what you needed for getting inventory, you took the revenue divided by the amount of businesses and then you multiplied it by the three.
For my beginning inventory?
Yeah.
No, I took my annual sales, multiply that times cost of goods sold, and then divided by 365, and multiply times 100.
It's like, I mean, for the whole.
I do that. Because the more information that you have, the easier the assignment is. I'm surprised it I really used to be a thing about 15 years ago, maybe it's falling out of favor.
I'm doing well. I'm a repair business, and I couldn't calculate my beginning of usually inventory for the rest of the days.
But auto repair business, what you gonna do? You're gonna call Advanced Auto Parts or Napa or whoever it is, and they're gonna,
Yeah.
you won't have inventory.
Okay. All right, I'll do.
Okay.
And we want a service station, and I don't know if I should buy a fuel tanker, because I don't need a delivery vehicle. So that's my only.
A service station selling gas and diesel and probably some,
Stuff like that.
okay. So are you going to lease the location?
Yes, I
Okay.
actually got one that's on 401 South,
Uh-huh.
that's an old Shell
Okay,
station,
all right. But you'll probably need a computer or
So
something,
look at
right?
industry neglect.
so that could be my big asset.
Yeah. You're welcome. Thanks.
So, I was on the property taxes, but I looked at the Grand Buffet, there's a restaurant. I was having trouble, I expected 50 stuff and tried to like figure out something good. Yeah, I couldn't figure out property tax advice, like.
Yeah, so go to wichitatax.com
Oh, okay.
and
So-
search by that location.
Okay, yeah, because the first one I was looking at, I saw it, just, I didn't know if that was, had to do with it.
Land assessment, property tax, it gives you the assessed value of it, but it does not give you what the taxes are. So I would just go look, search for that in specific location, in Wichita Tax, make sure that you have the legal description of it, and then you tell us how much it is.
Okay, also, I was kind of torn between doing the restaurant and doing what me and my roommate does, which is go with a fire for Pittsburgh sports. But like, so, because the way we're doing it right now is like online orders, we do it through the website. So with, for.
Because that shows you-
Project is like mostly for like nostalgia, so I like.
I mean, you still really simple. You pick a location to lease, you know, you can occupy. It's just the same exact question that Kira was asking, right? You don't do it out of your apartment, you just rent a storage space.
Okay. All right, well, thank you.
Yes, ma'am.
Okay, so my idea is, you know, like where the Flex has the roller rink next to it.
Well,
Okay, I know there's land next to it, but obviously it's not like for sale or anything right now. What I was thinking of is
Oh,
ice
you can add it on the
skating that's
same
all
line.
year round. You know, I
so
know
it's
Dallas
like
and
use
stuff,
those
you know,
160.
people skating and everything and
You
skating those, and blah, blah, blah.
Fine.
Instead of having to wait for the ice at Cave. How do I do that for as far as taxes? Because there's not necessarily something being offered. I mean, it's not, you see what I'm saying? I mean, it's,
Yeah, that
there's
would be-
land there, but, and I would buy it, but it's not, probably not listed for sale.
So you have to really estimate how much it would cost you to build that facility, and that's gonna be a fairly complicated business.
That's kind of what
Yeah,
I'm
it's-
thinking, and.
It's fairly complex, Mary, 'cause
Yeah.
I would probably steer clear of it. I think it's a good idea.
Maybe just
And
get
if you-
another space
Oh,
or
yeah.
something that's actually open or.
Yeah, could you do it, could you buy a location that's existing, go to that same LoopNet.com, look for stuff for sale,
If you want to do it.
and then just.
Yeah, I can definitely do that. I was thinking, so actually, it'd probably be okay. I mean, I was thinking it'd be good location and everything, and if they didn't want to roof, but then there might be competition to do, so.
Yeah, they would be,
So, yeah, exactly. I mean, that, because I'm skating, but
you're
that's,
still competitive. It's
So-
still recreation, leisure and recreation.
yeah, and it's, I mean, you know, I just looked up ice rinks. There's nothing, that's for Florida. It's like $800 something billion. I was like, holy crap. Excuse me, I didn't even say that. I was like, oh my gosh.
That's a lot of money.
It was a lot, so, anyway, okay, that's kind of what I was wanting to figure